been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Today I'm going to answer the question for you: should you invest in Intel stock after its recent major crash? Before we get to that though, I need to let you know you can get the series as a podcast and for free on all major podcasting platforms: iTunes, Stitcher, SoundCloud, Spotify, Anchor, and more, as part of the I Love Value Investing podcast. And also, before we get to this, I'm going to do these trainings on a regular basis. So if you want to sign up for these free live trainings, or these free kind of recorded trainings, I guess, make sure to sign up below. There's a link below, and all you have to do is input your name, input your email address, and that's it. And you'll get these free live trainings. The reason I'm doing these is to help as many people as possible during these crazy times learn this valuable skill of value investing and picking stocks, because at some point relatively soon, there's going to be a major crash in the stock market. I don't know when. It could be next week. It could be 2 years from now. I don't know when. But at some point, there's too much speculation going on. Earnings are falling too much. And yet the market still keeps going straight up. So at some point, there's going to be a major crash. So I want to help as many people learn this skill in these kind of free live recorded trainings. So let me take you, after the intro, let me take you to what we're doing here. So I'm going to cover this in several parts. In this first part, we're going to do the preliminary analysis of Intel. Second part, we're going to cover why its stock fell so much I think it's 20-30% in the last week and a half maybe. I'm going to tell you why that happened and what it means kind of going forward. And in the final part, I'm going to answer kind of the final question of should you invest in Intel. So before I do that, I'm going to kind of back up and show you my process for evaluating stocks. So I've already found Intel, so we're not going to show that part. The reason I want to look at Intel is because I have researched it an enormous amount in the past. I used to own it years ago when I first started investing. Intimately familiar with the company. I was thinking about buying it months ago, and then frankly, its stock went up so much that I couldn't buy it, or it went up to where I was not comfortable buying it based on its valuation. And now its stock has fallen again 20, 30, 40%. I don't know what the exact number is. We'll get to that in the next part. But fallen 20, 30, 40% after it announced a major delay to one of its new latest product offerings. So I'm taking a look at it again, and I figure I'd share this with you as well to help you learn as well. So what you're seeing here, again, I've already found it. My first kind of part of my process is finding the stock to evaluate. Already found that. Now we get to, I've done a visual preliminary analysis checklist on this stock. It looks good. And this is from a previous analysis. So we're going to do this brand new right now. I've not done this on Intel yet. This is one of the last stocks I evaluated. I did my full preliminary analysis on this was for another student. So in one of our training sessions. So we're going to do this brand new live right now. Or again, you're seeing the recording of this, but I'm doing this live right now. I haven't looked at Intel stock other than I've been watching its stock drop and I've been watching the news on it. I haven't done this full preliminary analysis on this stock in probably years, frankly, or months. Sorry, I forgot that I looked it up a couple months ago or a few months ago at this point. But I need to redo this again because it's been, again, several months. So anytime I look up a stock, even if I've done this before, if it's 3, 4, 5, 6 months, even longer later, I do this over again. Because the economics of the company change. The revenue goes up, the profits go up, profits go down, cash flow goes down, all that kind of stuff. The economics of the company changes over time. So you have to do this every time you look at an investment, and especially with the coronavirus crisis stuff going on right now. And in particular with Intel's delay as well on top of this. Their economics have changed quite a bit. So I'm going to do this again quite a bit. If you want, this is my full preliminary analysis checklist. This is, I developed this checklist myself over the last 13 plus years of investing in stocks. This helps me gain clarity on what I'm looking for at kind of a high level view. So the reason I developed this was because I found out that I was spending an enormous amount of time evaluating stocks that were terrible. So I wanted to figure out a way to kind of screen through those stocks faster. So that's why I developed this preliminary analysis checklist. I'm going to take this away for a little bit while we go through the notes. I have two screens with me, so we can go through this, but I'll bring it back. I'll bring back this sheet once I fill it in, but I want to kind of speed this up. If you want to see a full preliminary analysis or you want to go through this with me, again, sign up below. That's part of these free trainings. So I'm gonna go through these free trainings, take viewer requests on what you want to learn. If you want to learn this entire process, if you want to learn from our full masterclass, you can learn some of this stuff in these preliminary trainings, which you can get access to below, and also have a link below to the masterclass, which is my full kind of class where I show this entire process from beginning to end, every single little nuance you need to know about value investing. I show in that. So I'll include all the links for all of this below this. So 203 billion. So for now, I'm going to kind of go through this relatively quickly though, because frankly, I don't want to waste your time, and sitting here watching me kind of calculate numbers is probably going to be pretty boring. So I'll be back in a little bit after I calculate all these numbers, and I'll tell you what everything means in them. Okay, I'm back. Calculated everything out, or most everything up here. From here to here, I've calculated out for you. And then we'll do this together because this is interesting and usually is where companies fail for me. So I'm going to, again, if you want to watch some of our other preliminary analysis videos, use either the links below or sign up to our free live training list, and you'll get some of those as well. If you want full context on these, again, for now, I'm going to kind of go through these quickly. Market cap, that's the size of the company based on its share price. The reason I want to know that is so I can go back in time, because I save these. So if I go back years from now, I want to know what any of these numbers are. I don't want to have to go back and look them up. I don't want to have to guess. I want to know exactly what they were on the date I looked, to kind of compare and contrast to what the company's doing now at that point in time that I'm looking at. Dividend, straightforward. Okay, so operating margin. The reason I want to know this is because I want to know how profitable the company is from its operations. I look for anything above 10% on a consistent basis, and in the trailing 12-month period, Intel is at 33.4%, so fantastic, and then the 5-year average is 28.8%. Again, I look for anything above 10% on a consistent basis, so this means Intel is a fantastic operating company. Share count fell from about 7 billion shares in 2010 to about 4.4 billion shares in the trailing 12-month period. That's a fall of about 23.6% in 10 years. The reason I want to know this is because if a company buys back shares, all else remaining equal, the underlying kind of profitability per share goes up. So the reason I want to know that is because if the profitability per share goes up, the price of the shares over time should go up as well. Excuse me, taking a drink of water. Book value per share, same thing. Book value per share, though I don't really use book value per share for much of anything anymore, unless I'm looking at kind of an NCAV valuation for these kinds of gigantic, great operating companies. The main reason I look at this is to see if it's growing. If it's growing over time, again, just like this, if it's growing over time, that kind of means the underlying value of the company is going up over time. Again, there are nuances and problems with this, which again, I'll link that video below where I talk about the one area or one time the book value rising is bad. I'll link that video below this for your reference. But in general, other than that one situation, which I'll link below, book value going up over time means the underlying value of the company is going up again, which I want to see that over time because that increases the value of our shares over time. Return on invested capital. Again, a different profitability metric. I want to see how profitable a company is from its operations. This is another way to tell that. And this is specifically based on mostly its assets, the way I calculate it. How essentially what this measures is how well a company is using its assets to earn high returns on capital. Again, generally that pretty much always the higher this is, the better. I look for anything over 10% on a consistent basis. So again, Intel breaches these or surpasses that threshold. Okay, the only reason this is on here, I don't use ROE for anything other than to compare it to ROIC. Because if ROE is higher than ROIC, it automatically knows that the company has debt. And if it's a lot higher, it means the company has a lot more debt. So this is something we'd have to look at if we're going to go further in looking at Intel. As I can tell just from comparing this number to this number, that the company has a decent amount of debt. So we didn't want to figure that out, make sure we're comfortable with it. The level of debt compared to its operating profits and its free cash flow, which we get to next. So free cash flow to sales, 27.7%, trailing 12-month period. 5-year average is 20.3. I look for anything above 5% on this metric to consider that the company produces a ton of cash flow. Intel does produce a ton of cash flow, which I'll kind of illustrate a little bit. The absolute number on that, how much it's producing. The reason this free cash flow and operating profits are so important is because if the company is earning a lot of money from its operations, which these show that Intel does, that means not only is it a great operating business because they surpass my thresholds, and again, I'll mention why that's important in a second, those thresholds, but it also means that the company either likely has little to no debt, it can pay a dividend, it can fund research and development, which is super important for Intel from its operations, and it doesn't have to issue shares or dilute shareholders. Essentially, boiling all that up is if the company produces a lot of profits from operations and free cash flow, it means the company can operate in a healthy way without having to do things it's kind of forced in a negative way to do. Like you're seeing today with the coronavirus stuff, a lot of companies, their revenue, profits and stuff are going down, and they're either having to sell an enormous amount of shares to stay alive, to get cash and stay alive, or they're having to issue a bunch of debt to stay alive, which these are kind of short-term band-aid fixes in the most case, and for many cases in the situation we're dealing with today. But if you produce a ton of operating profits and free cash flow, that protects you from having to do that kind of stuff. Another reason these are important is because of what we'll talk about in a little bit. Might be in part 2 actually, but I'll tell you more reasons why these are important as well. Okay, it's cash conversion cycle. Pretty much nobody else talks about this. This is one of my favorite metrics to use. Cash conversion cycle measures the time it takes for a company to turn to buy inventory, to turn that inventory into sales, to turn those sales into cash, and to kind of repeat the cycle. The lower this number is, the better generally, because it means the company is selling through or turning their inventory faster, which means the cash conversion cycle goes faster and the company can get cash faster and all that kind of stuff. So generally, you want to see this going low over time or staying about stagnant if it's already low. What you see here is, again, this is a pretty big rise in the last 10 years for Intel. So we would want to figure out, well, if we're going to read their financial reports, why that happened. Again, I'm very intimate knowledge of this company. I used to own it. I've researched it a couple months ago, very in-depth. So I know why this is, but if you don't know why this is for a company you're looking at, you need to figure out what's going on. So the reason this is for Intel is because they've had some issues in manufacturing and developing their new products, their new product lines, which again, we'll get to more in part 2, but that's a big reason that their stock fell so much in, again, I think about 7 to 10 days ago, their stock fell about 30, 20, 30, 40%, something like that, and it's still down. So they've been having some product and manufacturing delays, so that's why this number is quite a bit higher. So here's where we get to this. EV to EBIT. So enterprise value. I don't like market cap, just as a kind of basic valuation metric or use in a valuation metric, because the only thing it tells you is the share price times the number of shares. It doesn't tell you if the company has debt or cash, which of course 99% of all companies on Worth have one or both of those. So that's important to know. The reason I use enterprise value on top of that is because when I buy any stock for myself or the portfolios I manage, is I look at it as I'm buying a chunk of ownership in the entire company, and I want to know what the entire company is kind of valued at. So that's why I use enterprise value. Again, I'll bring this screen back in a second, but I want to go through this with you so you can learn this, because it's an incredibly value metric and it's easy to calculate. So again, I'll bring the calculation back, but enterprise value equals market cap minus cash and cash equivalents plus short-term and long-term debt and debt equivalents. I added that. I'll tell you why I added that. And plus preferred stock plus minority interest. So most companies that I look at are smaller companies. They don't have preferred stock or minority interest. But I'm assuming, because Intel's been around for so long, they might have both of these. So that's why they're left here. Okay, enterprise value is 203 billion. Let's bring this. Oh, sorry, I have a tab suspender app when I'm not using my tabs for a while, and it suspends them, so I have to bring these back up. So I apologize for the delay here. Okay, and you want the quarterly data pretty much all the time, so you have the most up-to-date information. So they have an enormous amount of cash and cash equivalents, 25.8 billion. 25.8 billion. Okay. Current debt, so that's short-term debt. So 2.25 minus 2.25, or plus 2.25, sorry. And short-term debt and capital leases. Again, I go through all these individual things in the masterclass and other trainings. So if you want to watch those and you want to know specifically what they mean, make sure to check out the links below this video. They have a very large amount of debt. So 36.1 rounded up in long-term debt and obligations. So this equals, I'm going to save this actually now that I think about it, for, let me bring the screen back over. We've got all the numbers, or we've got most of the numbers. So this is where I'm at in the calculation here. I'm going to save these for another time when we talk about total enterprise value. But this will give you an advantage as well when you evaluate a company, because it'll help you find the value of things like operating leases and other things that aren't counted in most valuations that you want to know as a total business owner. But we'll talk about that in another session, because that takes a little bit longer to go through, because you have to look at their most recent annual report. So let's go back to see if they have preferred stock. Oops. That's usually down here if it doesn't come up on the search. Doesn't look like they have any preferred stock. And doesn't look like they have any minority interest either. That would be, let's do a quick scan, see if we see any. Okay, I'm not seeing any of that. So we're done with the calculation. So again, normally if I was, actually I'll just do it. So plus 0 in preferred stock plus 0 in minority interest, just so I know for sure. And then let's just do the calculation now. 203 minus 25.8 plus 2.25 plus 36.1 plus 215.55 billion. So what this means, because this enterprise value is larger than the market cap, is it's one sign that the company could be overvalued. The reason I word it like that is because I don't rely on just any one metric for anything. I rely on an entire analysis of a company and multiple different metrics that show me different things. So that's why I word it like that. Bring this up here. So you notice with these are called relative valuations. Another relative valuation that you're probably familiar with is price to earnings. I don't use price to earnings. Again, I have several videos of why I don't use price to earnings or net income. I'll link those below as well. The reason I prefer this is because I already talked about enterprise value. It shows you a more kind of realistic look at the entire company, including its cash and debt. And the reason I don't use earnings or net income, I use instead operating profit or EBIT and free cash flow, is because these, to me, are true indicators of, excuse me, true indicators of the profitability from a company. Plus, there's another, they're harder to manipulate than net income. So again, I talk about net income and why I don't use that in several videos that I'll link below this as well. So that's why I use EV to EBIT and EV to free cash flow. I also use EV to owner's earnings, but owner's earnings is a completely another calculation that we'll talk about some other time because that takes a little while to calculate by itself. So what is there for this? You want the trailing 12-month EBIT and the trailing 12-month free cash flow, which is free cash flow 21.9 billion, 21.9. EBIT, so operating profit is 26.4 rounded up, 4 rounded up, and then you just do the calculation. 215.5 divided by 26.4 equals 8.2 rounded up. And this is 9.8 rounded up. So what I look for on these metrics is anything below 8 to show that the company's undervalued. And again, remember the enterprise value, this gives you more realistic look at the company, because if we didn't have the debt in here, Intel would be enormously undervalued. In here, we're including the debt. Sorry, my dog. And this is why I love this metric again, because I want a most realistic, conservative estimation of the value of the entire company. And without debt, that is impossible to find out. Sorry, I don't know what my dog's doing right now. Apologize for that sound again. So that's why I also love enterprise value, because as a conservative, deep value investor, I want to know everything I possibly can about the company. And that, of course, includes its debt. So I look for anything below 8 to say that the company's undervalued on these. So by these estimations today, again, these change over time. By this estimation today, Intel is slightly overvalued. There's a caveat to that, though, that normally I don't talk about when I talk about valuation, is because most of the time I focus on small, tiny, nano cap companies, sub $500 million companies. Most of those companies don't have competitive advantages, so you can find them at extremely undervalued prices, even some today when we're at or near all-time highs with valuations in the stock market. For companies that have gigantic competitive advantages like Intel, unless there's some kind of major scandal of some kind or major recession of some kind, or the stock market is more rational than what's going on right now, that's pretty much the only time you'll see companies with huge competitive advantages like Intel that are incredibly undervalued. So right now, because Intel looks like it's about fairly valued, this is likely because of everything above a stock I would continue researching at this point. To illustrate why these are so important, you take the inverse of these, so 26.4, 15.5, 12.3% rounded up. Oops. And by 215, 10.2% rounded up. So earnings yield shows you the estimated amount based on today's numbers that you should expect to earn owning this stock within the next year if you were to buy it today. The higher these numbers are, the better. And are you going to earn this exact amount? No. This is just an estimate based on the currently available numbers that, today. So this concludes the preliminary analysis part. You'll see I have other notes down here that we're not going to talk about today because that is an entire another conversation. So I'm going to bring you back to my screen to finish talking about what we wanted to talk about. So we talked about the preliminary analysis of the company. Intel is a stock that I would look to research further today. Does that mean I'm going to invest in it right now? No, it means I'm going to research it further, which means I need to, at this point, this is where most companies, when I do my analysis of companies, fails. And it's most of the time because they fail on the valuation part. Meaning they're overvalued when I look at them. So if a company surpasses my threshold on this, or if a company looks like it's good after this kind of initial pass through, then I read its most recent annual report, quarterly report, proxy report, take notes on it from there. If it passes that, then I read 5 years worth of annual reports at least. If it passes that, then I do my full valuations of the company. Then I look for more up-to-date information, which again, we'll talk about a little bit of that here coming up in a few minutes. And then if it passes that, then I need to make a decision on whether to buy it or not. So I'm still at the very early stages on Intel in terms of looking at Intel. But it looks, as of right now, like a good potential investment right now, based on valuation, based on its financial metrics, based on its enormous free cash flow and operating profit production. There are some minor concerns that I would need to figure out in their financial reports. The biggest one is, to me, isn't even something that's on the list that I just showed you. It's, again, because I'm intimately familiar with Intel. I know they've been having manufacturing issues, specifically with their 7 nanometer chips. They've fallen behind AMD for the first time in years, decades, in terms of their production of a new chip. The thing with microchips is generally the smaller they are, the better they are, the faster they are, the more efficient they are, that kind of stuff. So when a next generation of chips comes out, it's a big deal in this industry. And Intel has been leading this industry for essentially since the 70s, when it kind of invented the first semiconductor / microchip. So now it's fallen behind. It announced I think it was a 6-month delay in its 7 nanometer production and release to the public. This is after a previous, 12-month delay of this product. And this is also on top of the news that the quote-unquote greatest semiconductor microchip producer in the world is having to kind of farm out the production of these processes because their production was so jacked up. Their production was so messed up that they brought on somebody to fix it. I think it was 6 to 12 months ago. Maybe 18 months ago, I think. I'll have to look that up, but excuse me. I'll have to look that up. But they brought in a chief manufacturing officer to fix these problems. And he didn't. So he just got fired and replaced. The guy that they brought on, again, 6, 12, 18 months ago, I think it was 12 or 18 months ago, got fired because these processes weren't fixed. The reason this is such a big deal is because this lowers potential revenue, profits, cash flows, lowers Intel's market share, and harms Intel's, frankly, competitive advantage that they've had for decades, again, being ahead of the competition, always being ahead of the competition. So that is the biggest, that is why this, getting back to kind of the initial part of this video where I talked about there's 3 parts. So that is why, this is part 2, why its share prices dropped so much. Again, 20-30%, which I'll bring up here. And again, I apologize for this. Share my screen again. Apologize for the delay because my suspender app suspended the tab again. So here's what Intel's done. Oops, reset. For the year. So hit, I think it was either an all-time high or near an all-time high back here in January. Kind of stayed around that same level until the really the coronavirus issues crashed mightily all the way down to $44 a share from, what was it, $68 a share. And now you can see this over here again. It's huge crash, kind of in the 60s range for a while after recovery from the initial coronavirus stuff, and then crash all the way down to $47 a share from $60 a share. So 47, 60, 47.73. So a crash of 21% in a matter of days, frankly. So this is what happened. This is why I'm looking at Intel stock. This is frankly the time you need to be looking at these kind of stocks. These bigger stocks is if they have some kind of issue. Because for most deep value investors, we can't buy these bigger stocks with huge competitive advantages most of the time because they're just kind of humming along doing their thing and kind of just going up in value the entire time. So when you see a company that falls like this, you need to figure out why, or you need to figure out if they're a good investment now based on the information now. You need to figure out why this happened. You need to figure out if you're comfortable with the risks of this issue, which is the stage, frankly, that I'm in next, and that I'll share in another, probably, I'm going to try to share at least one of these videos every month. The live trainings, again, we're gonna kind of position that as free live trainings into these kind of more in-depth trainings. Probably going to release these once a month, once every 2 weeks. That's the kind of plan right now. Most of these are going to be exclusive to people who either join our free live trainings or our paid monthly coaching or our paid monthly trainings via Zoom. This one I'm going to release for free to everybody because I kind of want to give you a preview and I want to show you my process. So you saw my entire process. That's that preliminary analysis doc. That's, again, developed over 13 years. I use that every single time I evaluate a stock. So you now know how to learn how to evaluate a stock within what we're at 33 minutes here. And I took some extra time because of delays and explaining stuff. So this, when you start using that process, will take a little bit of time to do. Usually it takes new students about an hour, hour and a half to kind of go through everything. Again, I've been doing it for so long that I can get through it in 25 minutes or so, usually. So you have that. You knew that. You have that skill now. You can actually evaluate stocks on a deep level and learn more information about them than, frankly, most professional investors. No, because most professional investors don't even read financial statements or look at the company or read the financial reports. It's shocking. If you're newer to this, that statement probably doesn't make sense. I guarantee you it's true. Again, I've been doing this 13 years. When I first started, I thought that was crap because you hear people like Warren Buffett and these other value investors say that most professional investors don't actually read reports, and it's kind of shocking when you hear them say that, but most of them don't. It's crazy and scary, but most of them don't. So you, by knowing that process, already know how to evaluate a company on a deeper level and a better level than most professional investors do. Found another stock. This might give you an idea of a stock to look at. Again, I'm going to release my kind of notes that I take after reading the Intel report and taking my notes. I'll release those to whoever signs up below for either the free live trainings or the monthly coaching. I'll release my notes to those people and our other subscribers and stuff, of course, for the masterclass, stuff like that. I'll release my notes to those. So if you want those notes and you want the next trainings, make sure to either sign up for the free coaching or the monthly coaching, which you can get. The monthly coaching you get for $1 trial, and then for 30 days, and then after that you get for $97 per month. And then we'll do these kind of trainings even more in depth than this. I'll show you my entire process in that. So you have that. You know why Intel stock fell, and I just remembered something else I forgot to tell you. So those thresholds of operating margin and free cash flow and ROIC, why I look for the margins above 10% on a consistent basis for ROIC and operating margin, and 5% on free cash flow sales, is because I estimate, after researching thousands of companies all over the world, that far fewer than 5% of all companies on Earth reach those thresholds. So that automatically puts them into the great operating business category if they surpass those and they are consistently past those. So that's why those numbers are important. So I hope you learned a ton from this. I hope you ask questions. If you have questions, let me know in the comments below. Again, I'm going to release this on the blog, on YouTube, through our email list, Facebook pages, and groups as a podcast episode for free. This one, I want to help as many people as possible. And again, you can sign up for our other free trainings below this to get our other free trainings. You can sign up for our monthly paid coaching, which will be even more in depth than this. And you can sign up for our masterclass, which again, I show you my entire process step by step with resources, with everything. I show you how to do everything. All the links for all this are below. If you have any questions, comments, concerns, let me know below as well. I went through this pretty fast, and I didn't explain everything as good as I normally do, because again, I have other training videos that are going to be linked below this that I can show you. So for context, if you're watching on YouTube, like, love, share, subscribe, comment, and hit the notification bell so you're notified anytime we release a new video. And we release new videos all the time. If you're listening on the podcast, like, love, share, subscribe, comment. We really also appreciate a review. The more views, likes, listens, loves, comments we get, downloads we get on our YouTube channel, on our podcast, the more people we can help with this kind of stuff. If you want that content, again, there should be a bunch of free stuff you can get down below this, paid courses as well, a bunch of resources to other free videos that I've done in the past, talking about things like cash conversion cycle and stuff like that. If you want those, and net income as well. If you want to know why I don't use net income, there'll be videos below this as well. So again, I hope you enjoyed this. I'm going to be trying to do more of these because, again, I want to help as many people as possible prepare before we hit that crash, or before we get that crash, become great value investors and stock pickers, because it's coming. Again, I don't know when. It could be next month. It could be 2 years from now. I don't know when it's going to happen, but it's going to happen relatively soon. And I want you to be confident in finding and evaluating stocks to multiply your wealth and to earn, or to reach towards your goals and dreams, to earn higher to make money in retirement, all that stuff. So I hope this helped. Hope you learned a ton. Love to hear your feedback in the comments below. And until next time, have a great day. Talk soon. Bye.